So inflation is the next of the 6 factors we want to take a look at. Inflation in the recent past has not seemed to have been a huge deal to a lot of people. 2%, 3% maybe. I can remember for sure when I was younger, inflation being way up in the double digits, and it was wreaking havoc, especially on retirees, people on fixed incomes. I mean, prices were just skyrocketing. So in the recent past, inflation as it by itself hasn't seemed to be huge. But look at the cost of things that we really depend on, that we need. Look at the cost of higher education. It's gone up 197% just since 1996. Raising a child, child care, medical care, 105%. Eating out, food, entertainment, 64%. Housing, 61%. So for sure, healthcare, you're going to be dealing with in retirement. And it could be 30, 40 years you'll be paying healthcare costs. So we got to plan for this. We got to plan if you want to go out, you want to enjoy, you want to travel, we got to plan for those skyrocketing costs. So maybe you're thinking, I don't need to plan for higher education or childcare. I've kind of done that. But maybe you want to help your kids. Maybe you want to help your grandkids. And those costs are way, way higher than the rate of inflation. So those are things we are going to have to plan for as well. I wanted to show you a chart here comparing this bottom number here is inflation, overall inflation. The last 10 years, well, between 2009 and 2019, inflation was 20% overall, about 2%, average 2% a year over the last 10 years. Wages, which is this dark blue line here, workers' earnings, they've actually gone up a little bit more, 26% over the last 10 years. It definitely doesn't feel like to me that my money's going farther. But if you look at inflation and wages, you think it might be. Well, look at that last chart I showed you. Healthcare was going up huge. Higher education skyrocketing. Going out to eat, entertainment, food costs skyrocketing. That's why I wasn't feeling like we had more purchasing power. So this one is just showing one thing, and that's healthcare. This green line here is showing how much premiums have gone up. That part you pay to keep your insurance. Premiums have gone up 54%, more than double, almost 3 times the rate of inflation. Look at these deductibles. That's gone up 162%. That's the yellow line here. 162% it's gone up in the last 10 years. Way, way more than inflation and way, way more than workers' earnings have gone up. So that's why we're feeling pinched. So our money really isn't going as far as it used to because these other costs are skyrocketing. So healthcare is a big one. We're going to have to plan for that. Let's just look at only inflation. We say it's averaged 2% over the last 10 years, 2% a year. That's been the average rate over the last 10 years. Just at 2%, if you had $50,000 in your nest egg, if that was that whole dollar bill, that was everything you would sacrifice for, $50,000. And let's say you were very careful and conservative and you thought, I'm not going to spend it. I'm not taking any vacations. I'm going to have it there just in case. Well, if you have it sitting there for 25 years, is what this is showing, you just lost half of your value of your portfolio. Your nest egg is worth half. When I say worth half, the purchasing power is half. Inflation has made it worth $23,349. I'm sorry, that's a 3%. 2% has made it $30,000. 3%, which is realistic, less than half. Just at 4%, you're down to $18,000 in purchasing power. So inflation matters. So here's what I said, 3% after 25 years, less than half. Now, how realistic is inflation going to stay low? I can't predict. I don't think anyone can predict for sure. But inflation's been 2%, maybe 3%. How realistic is that? Can we count on relatively low inflation. Well, this chart is showing you a couple numbers. One, in April 2008, the U.S. money supply was about $8 trillion. What is money? Why are we talking about money supply? Most experts believe money supply is one of the biggest factors on inflation. So I can give you kind of a oversimplified example. If there was $100 total in the economy and a water bottle cost $1, if all of a sudden there was $200, we just doubled the amount of money in the entire economy, that water bottle, the price would tend to go up to $2 a bottle. That's very oversimplified, but that is the idea of how inflation is tied to money supply. So in April 2020, the U.S. money supply is almost 17 trillion. A lot of that was the pandemic response, the stimulus money, all those things, probably very good things that had to happen with that money. That's a 217% increase in the U.S. money supply since 2008. That's a 26 almost percent increase just in the last year. So it will have some impact on inflation. How much, where inflation will go? Could it go higher? I mean, these numbers here would tend to say it could definitely go higher. So we got to plan and we got to make sure that inflation is not eating away at your nest egg, that you're taking some action to protect it. So wrapping up, inflation, ensure that your nest egg, your portfolio, your dollar bill, everything that you save there, you want to make sure it's going to grow. If it's not growing over time, inflation and the skyrocketing healthcare and all those other skyrocketing costs, they're going to eat away at it. So even if you don't spend it in your retirement and enjoy it, it's going to get eaten away just by being there, just because of the longevity and the inflation rate and all these costs chipping. So we got to help you make sure, if we plan with you, that your retirement income grows over time, your portfolio grows over time, protect you from inflation. Now we're going to move on to our next area. John is going to talk about market volatility and how that really changes as you move into retirement, how market volatility affects you. And John, you take it over from here.